2022. Yesterday, the precious pulled back from its fresh highs as the dollar upticked and temporarily dampened gold's appeal. However, increased bets for a less hawkish Fed in the coming months put a floor under the bullion's price. In this report, we aim to shed light on the catalyst driving the precious metals price, assess the future outlook, and conclude with a technical analysis. Following the release of a cooler CPI print paired with a robust employment report, market expectations sparked hopes for less aggressive monetary tightening from the Federal Reserve, which fueled the bullion's asset in recent weeks. Currently, the Fed's funds future assign a 90% probability for the central bank to slow the magnitude of its interest rate hike in the February meeting to 25 basis points, lifting its target rate to 4.75% level. So far, the central bank downshifted to a 50 basis points rate hike in the December meeting, after 4 consecutive 75 basis point hikes, as it moves closer to its median 5.1% terminal rate. In recent weeks, however, market participants appear to be underestimating the resolve of the central bank as they progressively bet that the Fed will not raise rates beyond the 5% target level and will be forced to pivot and cut rates later on this year. Analysts base their projections for a less hawkish Fed on recent data on the inflationary front, as the annual CPI for the month of December showcased that the inflation in the US cooled as expected to the 6.5% level from the 7.1% reading of the prior month. According to the report, the headline rate was driven lower by easing energy prices and a further contraction in sales of used automobiles. On the flip side, however, housing costs were once again on the rise, signaling that despite the fall of the headline rate, the US market continues to face issues with inflation of a much stickier nature and inadvertently rises the probabilities of inflation becoming deeply entrenched. Nevertheless, the bolstered speculation for a smaller rate instrument from the Fed is expected to polish further the shiny metal in the eyes of investors as the dollar continues to experience outflows. Since the Fed embarked on its aggressive monetary policy campaign in 2022, other major central banks fell victim to the reign of the dollar, seeing their currencies devalue tremendously. Now that the Fed signaled it's about to lift its foot off the throttle, Bank of England, the European Central Bank, and Bank of Japan are expected to cover the lost ground and could possibly pose as a threat to the dollar's superiority. According to the latest Euro OIS, the market foresees the ECB to hike by 50 basis points in the February meeting, attributing an 87% probability for this scenario to materialize. Furthermore, the GBP OIS currently implies a 76% probability for the BOE to lift its key policy rate by 50 basis points as well in its February meeting, while tomorrow the Bank of Japan is expected to keep its ultra-loose monetary stance unchanged. However, since Bank of Japan surprised the markets last month by altering the bands of its YCC policy, market participants speculate that the central bank may abolish its YCC totally. Overall, the prospects for further rate increases by BOE and ECB, alongside the possibility that Bank of Japan is allowed to the quantity tightening of the market, could leave the greenback negatively predisposed for further weakening and henceforth provide extensive support for the bullion. Thank you for watching.